Welcome to the High Value Sales Show of Eversprint.com. I'm Malcolm Louie, the managing member of Eversprint, and today we're speaking with Chad Jampedro, the president of GSF Mortgage Corporation, a fast-growing home loan, reverse mortgage, refinancing, and new home construction lender. Welcome to the call, Chad.
Thank you, Malcolm. Thanks for having me.
Chad, you grew your company's revenue from $12.4 million in 2014 to $30.5 million in 2017, a 145% increase. And for this year, you're on track to hit $30 million in 2018.
That's correct.
To get to where you are today, what's the one thing your team had to consistently execute over the past few years?
We had to consistently implement new technology into our business. The mortgage business has, certainly very complicated from a borrower perspective and from a company perspective, lots of moving parts, compliance, and you need to find ways to automate those tasks as often as possible. And we consistently look for tasks within our business that we can automate to save time and create efficiencies for our borrowers. And we never take our eye off of that ball.
Can you share how your automation of the processes, the technology you've implemented, how that has reduced the time required to write a loan for people?
Sure.
Comparing your time from the time to close from 2014 versus till today?
So the time in 2014, you're looking at roughly 46 days from application to close. And today we're looking more like 20 to 23 days application to close. And a few of the systems that we've implemented from 2014 to 2017, the first is our origination system, which is Encompass origination system. Implementing that system over our existing origination system at the time created just a tremendous efficiency in the way our originators interface with our borrowers, the way our borrowers interface with the documentation that we were putting in front of them and submitting documentation to us. That was a game changer. Along the same time, we truly went to a paperless environment at that time. So everything is transmitted to us electronically versus getting physical documents either overnighted to us or walking into our offices, making copies, filing them. That became quite a task for any organization, especially as your volume increases. And then the next would be our pricing system, which is Optimal Blue. So that system is not much interface for the borrower, but it put our pricing for each loan product in front of our originators in an extremely efficient way. So they can search for scenarios and access that pricing in real time, live pricing in real time with just a few clicks of the button. So those two pieces of technology are really the hub of our business. And then we've added on with our CRM, HubSpot over the course of the years, and a number of other ancillary systems that may be more towards marketing versus origination. But as it relates to origination and the process in and of itself, Encompass and Optimal Blue changed the game for us.
Now, is Optimal Blue, is that your own in-house product, or is that an off-the-shelf product that other mortgage providers?
That's an off-the-shelf. It's widely used in the industry. Optimal Blue. Now, each configuration is going to be just a little bit different company to company. So how we execute utilizing that system is going to be a bit different than others, but it's available to other mortgage companies.
Okay. So you shorten your time from 46 days back in 2014 to about 20 to 23 days today. How has the industry average changed over that time period?
So the industry average is still 30 plus days, and there's a report that comes out on a monthly basis that's produced by Ellie Mae. Ellie Mae is the parent company of Encompass, and essentially it tracks all Encompass users and their timelines to close. Now that is across all mortgage banking entities. That can be banks, credit unions, non-bank originators like GSF, and it's still near 37, 38 days. Depending on the month. Sometimes in the summertime, you'll see that extend a little bit simply because you have more volume in the summertime, especially in the Midwest when folks are moving. And then as you get into the fall and the winter, not as much movement, so turn times get a little faster. So we're still tracking in most cases 2 weeks ahead of our competition.
So back in 2014, then you might have been losing opportunities to provide mortgages just because it was taking you 46 days to close, longer than the industry average.
Yeah.
Now today, you're on the other side of the coin, right? You're probably winning business that your competitors are losing because they just can't get it done in time.
Yeah, and and in many cases on a purchase transaction, we would lose it. I mean, so the expectation of the real estate agent is a 30-day closing. Now, maybe during the 2014 period of time, I'd have to go back and check those numbers. I think it was a bit longer than the 30-day. But the expectation was, hey, can I close in 3 weeks or 2 weeks? If I write this contract with a signing date of 2 weeks, can you make that happen? And we want to be honest with our referral partners and let them know, look, we're not tracking at that number. No, we can't. And yes, we would lose that deal. They would go to another provider that could close sooner.
Right. I mean, that sounds like you have a pretty big advantage right now, 20 to 23 days versus in this industry average of 30 plus days.
Yeah, absolutely. We feel it's an advantage. We painstakingly manage each task and the numbers as far as the micro conversions to keep those numbers as low as possible. And time is money, not just for us. Time is literally money for each one of our borrowers. If you have a rate lock that's out there and it's hedged, so you have a hedged loan in the secondary market, every day that loan is locked, that the loan is not closing, is costing your company money. Think of the hedge as insurance. So you're paying for insurance to lock in that interest rate. So if we quote an interest rate of, let's say, 4.5% on a 30-year fixed, well, once that loan is locked, we're paying hedge or insurance costs every day to keep that 4.5. If the market goes up or down, we're maintaining that flat average for that particular borrower, that flat interest rate. So every single day that ticks past is real money, real dollars that is spent on behalf of GSF for that particular borrower before their loan closes.
Right. So it's in your interest and everyone's interest to get this thing closed as quickly as possible.
Exactly.
So can you share with me how many loans you had written or you had closed, you had issued in 2014 versus 2018?
So in 2014 numbers, and again, I'd have to maybe go back to those numbers. I think we were tracking around 2,500 loans a month at that time, or 2,500 loans a year.
Okay.
And now we're over 5,000 loans a year.
Wow. And in terms of actual number of customers or clients, has that also increased similarly, or are people getting multiple loans from you?
So no, we increase. There are repeat customers in there, and we certainly love repeat business, but that's growth of core customer.
Okay, so you now have 2 times as many core customers today as you did 4 years ago as well, then, in line with your loan growth.
That's correct.
Okay, fantastic. Now, how does your company go about finding these new borrowers?
Well, there's multiple. I mean, our marketing is pretty diverse. We utilize a lot of pay-per-click. We utilize Facebook a great deal. But the majority of our business still is relationships. It's built with our referral partners, real estate agents, builders, financial planners, attorneys refer business to us, their clients to us. And that's still the largest part of our business. Then from there, we also utilize our database to continue to farm past closed customers and prospects for additional business, whether it be a repeat customer or them referring another customer to us. And then we also utilize a bit of direct mail, where we think strategically. We use a lot of direct mail for renters that we fill strategically, and we've had a great result on that type of direct mail. And a bit of radio advertising, or what I call marquee advertising, radio, billboard, a little bit of print. Our print is almost down, and in 2019, I estimate our consumer direct print advertising will be 0.
The disruption of the internet.
Yeah, no question about it. It's this. We thought, and we try to look for uncommon ways to approach our customer, and we want to do it in a way that's efficient to them, and we want to trust that our customer tells us how they'd like to be communicated with. And what we find is the internet works best, and we can drive information to them and educate them, and then ask them, hey, how would you like to continue to work with us? And in most cases, it's going to be via text or email. But what we find is when we utilize print advertising, we can't gather that information. So we find ourselves, maybe we get an inquiry and then we just kind of call because we're not able to kind of grab from them the information from a communication standpoint that's relevant in a way that aligns, right, so that we can actually get to them. So we find ourselves in this circle of, okay, we have a lead, but we just can't get a hold of that lead. But in utilizing the net, we can target a little bit better, and then we can gather more information on how they would like to be communicated with before we communicate with them, which then really starts off the transaction in a positive light.
Do you think at one point, though, down the line, it actually might make sense to use direct mail again? Because
yeah, that's why we've increased direct mail over over 2018 versus 2017, almost none. Now in 2018, it was roughly 3% of our marketing budget, and we anticipated going to as high as 10% in some markets for marketing budget. We just feel like direct mail is now becoming kind of an uncommon way of communicating if you send the right pieces and we keep it educational. And the timing is right. I don't necessarily believe we mail to folks every single month or every single week. So we want to pick specifically and very targeted information that's hyper local. So sending, what we found from direct mail is that if we send things out to say, hey, the national average is this and we're this, that doesn't go so well. But if we can keep it local that says, hey, this is what's happening in your city and town, then we get better response.
Right. I can see how that would work really well. And plus, and I imagine my situation is similar to most people, I get so little direct mail of relevance anymore that getting something that's targeted and to me that's useful it's almost refreshing for a change, right? You just don't expect it.
No question. The majority of the things that I'm getting in the mail are, either credit cards, hey, sign up for this credit card, or retail catalogs. I wonder how companies spend so much money on catalogs. Is there a return on that investment? I mean, you get the big it had to be expensive to produce and then expensive to mail, and it's coming to me and there's zero interest and it goes right in the garbage can. I mean, how long before that changes?
Yeah, exactly. It's I guess it must make sense because they keep on doing it, but it does make me wonder as well.
Yep.
So in terms of the channels that you're using to generate new business, which one's the best one in your opinion? The one that you would say, let's do more of it. Let's invest more into this channel.
Pay-per-click advertising is, our highest return on investment. There's so much analytics in and around, how a lead is behaving, how our ads and campaigns are behaving. So there's a trust level there that goes a long way because we can see it. It's very transparent. So that is probably, at least at this point, our largest lead source that we would want to continue to, maximize our investment in.
And what percentage of your new business is coming from pay-per-click ads right now?
It's nearing 20%.
Wow, that's pretty big.
You're right. So that continues to be, it continues to grow for us. And what we found is that we can take pay-per-click advertising and again make that very hyper local. You can run pay-per-click advertising that's very specific even to one municipality, and you can constantly continue to turn over new stones of opportunity, in particular locations. So again, pay-per-click is just, not to say that it's not uncomplicated. There's complications there. You've got to understand it. You have to have an individual who understands it at the highest level. We have a pay-per-click expert on staff here, and you're constantly just looking at your data, adjusting your data. Yeah. I have a management approach, which is a very simple management approach that I use for not just everything that we do on the corporate side, but everything we do within our branches, how we train our salespeople. It's plan, measure, adjust. Plan, measure, adjust, and then measure, adjust as much as needed in order to reach the result that you're looking for. So the measure, adjust piece we're constantly doing almost on a daily basis for our PPC. We measure and then adjust a little bit, measure and adjust to get the maximum out of it that we possibly can.
Right. Now, are you finding that the AdWords, Google AdWords is the platform of choice for getting more leads, or does it come from Facebook or some other source?
So it's primarily PPC through Google, so the AdWords platform. But what we found is we use cross-platform marketing, which we pixel. So if they're touching an asset on whether it's opening an email or they're clicking on it, we're gonna utilize the pixel to drop into their cookies, and then we're gonna cross-platform market. And I'm sure we've all experienced it where maybe you click on an ad in Google and then all of a sudden you open up your Facebook and then there it is. The product that you clicked on in Google is right there in front of you on Facebook or Instagram, and we utilize some of the same strategies.
Right. Awesome. Now, 20% is coming from your PPC pay-per-click campaigns. The other 80%, is it primarily coming from your referral partners, from referrals from your existing customer base? Or is there another channel that's working even better than that?
Probably 60% from referrals. And again, these are just round numbers.
Yep.
And then there's another 20% that is coming from all those others. That's, it's direct mail. It's some of the billboards that we have up, the radio advertising, and, some of the print advertising. And educational events that we do where we may have first-time home buyer seminars or move-up buyer seminars. So, that's about 20% of our business that comes from all those multiple sources. And we're constantly trying new things. So there's always some research and development, new ways to market. We're getting into more of the predictive analytics stuff now that trying to, message and work with folks before, as we see them leading up to making a buying choice for a home loan. And, that's all kind of included in that last 20%.
Mm-hmm. Now, have there been any channels that you thought held great promise, but then when you and your team tried it out, experimented with it, you found it to be just a complete disaster?
Well, I'll tell you that we've had success with Facebook from a retargeting standpoint and a cross-platform marketing, but just Facebook broad-based posting an ad and promoting it, we thought that would be a win for us because we felt that it would follow some of the similar behavior as PPC, but it's not. We would get leads, tremendous amount of leads, but they would be leads that we either couldn't get a hold of, or they had or they made a mistake. They thought they were liking something, but then it turned into a lead. Facebook kind of uses a scrape, so if someone clicks on an ad, you can actually scrape their page and pull in their contact information even though they didn't fill it out, and then you can contact them. But when that lead would flow from Facebook to a salesperson and the salesperson would reach out to them, and in many cases they didn't know why we were reaching out, or they did not fill out the form. It actually just was pulling the data right off of their Facebook page, and they didn't like that. So now you have a negative situation with a borrower or with a client, a potential client, that you have to overcome. And that's difficult to do when you're just making that initial introduction that says, why are you calling me? How did you get my information? And then you explain to them, well, you clicked on our ad on Facebook. Well, yeah, I clicked on your ad. I might have liked the image, but I wasn't interested in talking with someone. And Facebook on a surface seems like this great opportunity. And it can, if you're selling just leads, which we see that all the time, they're like, hey, we'll sell you Facebook leads. I know what those leads are, and we can produce those on our own, but the conversion rate for those were dismal.
Right. I could see that. I mean, the intent is totally different on a Google AdWords versus a Facebook ad.
So what we've done on Facebook is, again, more permissions, where first of all, we're not scraping that information off. We're gonna bounce them. So if they click, and we'll share the free information with them, but then they're going to have to take another affirmative action, meaning click to our website and then fill out a form, because now we know that it's intent-based, right? They made another click and they filled out a form, so the likelihood of them intending to contact us and for us to contact them goes up a great deal.
Right. Now, do you think it's just simply a case where you haven't fully figured out the best way to utilize Facebook, or is it just simply Facebook and people interested in a mortgage, it just isn't a great fit for each other?
Well, I think I won't say that we're masters at the Facebook market. I think there's always someone out there can do a little bit better, but in our experience in marketing financial services on Facebook, our secret sauce is that intent-based marketing versus just the broad scorched earth approach. So you're going to get less of a result for your spend, but it's certainly it's compelling enough to continue to develop it.
Right. So you haven't fully given up hope on it, but it's
Correct.
not one that you're going to go in aggressively like you are on your AdWords campaigns.
Yeah, I mean, AdWords, typically it's going to, again, it's intent based because they're searching.
Yep.
They're looking for something and then they click you. That's, they're there for a particular reason. But then the cross-platform marketing, which kind of spreads from PPC over to Facebook, over to LinkedIn, that works really well. So we're happy with that result for Facebook, but just native Facebook marketing, our approach is going to continue to be free information. That's a big deal, right? I believe in education. I also believe that the hardcore close and financial services is dead, and it's been dead for probably 2 decades. Folks, information with the internet is widely available, and we want to be a source of that information. We want to put goodwill into the marketplace that says, hey, here's information, use it, absorb it, learn from it. And then when you're going to make your buying choice, our expectation is that you remember us and come back to us because we're the source of that information. And then from there, interactions with the free videos or the free white papers or whatever it might be, more inbound style marketing, we're going to retarget them to come back to them and find out or try to find out when is the best timing for us to continue the conversation. So let's say for a first-time home buyer, they go to Facebook, they watch a video. We may, from there retarget them to say, hey, are you interested? If you're not interested, when do you think you may be interested? Is it in 6 months? Is it in, is it a year, 2 years? Or did you make a mistake? Are we sending this to you in error and we'll take you right off of our list? So we want to give them more credit in the ability to tell us how they want to interact with us. We actually have it on all of our mailing lists that say, look, I want you to send me free information, but I never want you to call me, right? I'm not interested in any calls to action. I'll let you know when I'm ready. And we're okay with that. We feel like if we respect our potential clients enough to let them tell us how they like to be communicated with, what type of content they want to absorb, and maybe they continue to absorb it and never use us, as for a mortgage company, we're okay with that because we feel like on the margin we're going to win more of those relationships than lose them.
And the marginal cost of delivering it, especially over the internet, is almost zero. So it's fantastic.
Exactly right.
Now, it sounds like you do a lot of stuff in-house. Do you outsource any of your marketing outside of perhaps
we've done? There are certain systems that we work with that are outsourced, but I'd say it's kind of semi-homemade, right? So I think you probably heard that term before. We may use a vendor for certain aspects of it, but creative is done internally. All of the reporting and tracking is done internally. We try to control it as much as we can, simply because you find angles to shape your messaging, and sometimes it's hard to translate mortgagees to a marketing company. And we've had those in the past. We've worked with them, and they do a great job, but they don't understand our business as well as we'd like them to. So there's this heavy overhead of explanation. Yep. And for any really good marketer, having a native understanding of the product that you're selling goes a long way. And typically when you hire an outside firm, they don't have it. They don't have a native understanding of it. So now you're explaining to them what it is, why it is a certain way, what are the elements that make it up, and then from there finding a marketing message. So we find it much more efficient to have the marketing staff here, not to say that they come in initially with mortgage experience, but we train them over the course of a period of time, immerse them in the mortgage culture, and then all of a sudden you have a great marketer who understands the mortgage business in a relevant way, and you get fantastic, relevant marketing out of them that actually makes an impact.
Right. Definitely the case. So I noticed how in our conversation so far, you haven't mentioned a few things that commonly come up as being marketing channels that companies are investing. SEO, social media, the Twitters and the Instagrams and so on. What are your thoughts about that when it comes to the mortgage space?
So we have SEO strategies in place on the organic side, and that's a kind of a moving target, and we do track what our organics, what our results are from an organic perspective. We probably could do better there. We certainly could. We tend to lean more on the paid side a bit. As it relates to social, we utilize Facebook a great deal, and with that, Instagram comes along, and the new demographic, and the millennial is certainly a part of that that new demographic, that it performs well on Instagram as well. But you have to have the messaging right, and you have to be relevant to the platform. LinkedIn, in my opinion, is a business-to-business platform, but I see folks do utilize consumer direct messaging on there all the time. Facebook is more of a consumer direct, but you have to be careful about your messaging because there's an expectation on Facebook that you're sharing something that's relevant, and that it's not just a hardcore sell all the time. Twitter, we've had almost no success with. You have 140 characters, but you can post video. It's in my opinion, on the financial services side, there's a larger story to tell there, and we story sell a great deal that translates. So telling the story of a first-time home buyer who started one way and ended up in another, or an originator that did a great job on a particular transaction, really does translate well to Facebook and Instagram, but not as much to Twitter. So we spend zero budget on Twitter. We do have a Twitter page and we tweet out information, but we really haven't found a way to make it relevant to our business that actually generates leads that are closable.
Right. Taking a step back and maybe looking a bit into the future, in 2018, you're looking about $30 million of revenue. What are your targets for 2019?
So, there's a macro, there's a macro market that we're participating in. And as interest rates rise, typically you're going to lose refinance business, which is a more transactional business, less expensive to the organization. That went down over 30% from 2017 to 2018. So we're pretty comfortable tracking at the same numbers, from 17 to 18. So the number in 2019, since we don't know what those macro numbers will be, how much will interest rates go up? That's going to impact our business. So if we could stay steady over the next few years at the same revenue, not to say that we don't want to grow, we look at this year as a growth year, since the majority of the industry took a step back from a revenue standpoint and we maintained about the same. That's growth for us. And we would expect the same thing. So if to give you the honest answer to that question, if we track the same number in 2019, we would be happy with that number.
Okay. Yeah, totally understandable. It's really a function of how well the U.S. economy is doing, like you said, and interest rates more than anything else, employment and so on.
Geopolitically, that has an impact on our business. It moves money. The investment dollar can only be spent one way, right? And typically, the bond market, which is what controls interest rates, so the yields on bonds, if they are going up, then interest rates go down. Yields on bonds go up when more people are buying bonds. Typically, in a market that we're in, stocks are doing really well. So that investment dollar is going into stocks out of bonds, which raises interest rates.
Yep.
So, if we hit a recession, which, depending on what news entity you read or consume, some projected in 2019, maybe at the end, some in 20, some in 21, some in 22. If you get close to, and we have an inverted yield curve now, which typically is an indicator, and at least the last 18 or 20 times that has occurred, we were not more than a year and a half away from a recession. We've hit an inverted yield curve, so that is an early indicator of a recession coming. When that happens, typically, funds go from stocks into bonds, yields go up, rates go down. On our business, picks up. So you're going to have more refinancers, more of those transactions, folks coming in to reduce their interest rates, which then is a boom for the mortgage industry.
Right. So if say the next year or so continue to expect that the mortgage industry on whole is going to have a tough time at it, and your aim is to keep your revenue steady, which essentially you're still growing. It's in light of the difficult macro conditions. What's your plan to continue growing your business, to continue getting the same number of mortgages closed and funded each year?
Well, it's twofold. So it is in smart growth from a hiring perspective. So bringing on origination teams that are capable of originating at a high level in the current market, not the previous markets where you had lower interest rates, more refinance transactions. So more purchase-centric teams joining GSF. The second is to continue to invest in technology to make us more and more efficient, which then typically will attract individuals to you, both from a customer standpoint and from a salesperson standpoint, says, hey, I want to be a part of this. So we continue to tell that story about how GSF is closing 2 weeks faster. We typically have a little lower interest rate. That is going to drive borrowers, especially in a slight marketplace, to the strongest, the strongest survive. And if you're perceived to be that and you're an efficient closer and you have a lower interest rate, you're going to pick up more market share. And then teams that that identify, hey, GSF is the place to go to enjoy that for my business within a business, that also helps us continue to grow.
Right. Now, are there obvious inefficiencies in your processes right now that you've identified that that you can shorten and speed up?
Well, listen, the document gathering process is we've made that as efficient as possible, and I believe there's still more work to do there of getting the information from the source, the repository. So, a good example would be, listen, we're going to need a bank statement from a borrower to close a loan. And in our current scenario, we have a very efficient way for them to upload a bank statement that they print out from their bank to us. And we have technology in place now, but we have to continue to build awareness around it that would say, hey, if you type in a one-time use password, we could actually just pull that right from your bank, your bank, pull the statement right from your bank. So you put this one-time use password in for Bank of America, we'll just pull it directly from there. Building awareness around that, because right now that's really a challenge because of the trust factor. Our clients are saying, listen, I don't want to share with you my Bank of America username and password. They don't think, obviously there's, you can highlight in over the past few years, identity theft and folks' credit being compromised. So they're weary of that. That's a good thing, by the way. That's not a bad thing. But this is pretty safe, stable technology that's absolutely 100% secure. Building awareness around that will help us become even more efficient. Now we don't even need them to go and print it out and then upload it or scan it or put it into a PDF and upload it into our system. We could just go there and grab it. And in doing that cuts the energy and effort from the borrower side of things and from our originator side of things, which allows them to focus more on education and understanding the strategy of their loan rather than scrambling to collect documents and upload them and get them into our systems. So we want to make that an afterthought.
Right. I can see how that can be a huge plus, but at the same time, I can understand their consumer hesitation, right? Because Certainly. You never know if someone's going to make a mistake down the line and that information gets released out in the wild.
Right. And unfortunately, in our business now, again, we still believe in it and support it. The amount of documentation after the mortgage meltdown did not go down. It went up. So the demand for information is increasing. So, it's not uncommon to talk to a borrower who maybe has done a loan, let's say in the early 2000s, and they haven't done anything with it since previous to the meltdown and all of the changes in compliance. And for them to say, wow, the last time I got a loan, they didn't ask me for all of these things. And now you're asking for everything, and you also need a blood sample. They feel that the barrier to get that loan has gone up quite a great deal. So it's our job to utilize technology to take that feeling away. Yes, there's a higher demand on information, and we can all understand why the repercussions from the meltdown were because of lack of documentation and investors not knowing what they're investing in. So that has gone up a great deal, but it's still a challenge borrower by borrower. So you want to put good strategies in place from a technology standpoint to help you bridge that gap so you don't get that feeling from them that says, wow, this is way more invasive than I expected.
Right. Yeah, totally understand that. I can see that. 2 last questions for you, Chad.
Sure.
Who are your ideal customers, and what's the best way for them to contact your team?
So our ideal customer are an individual who are interested in home ownership, whether that be in refinancing their current debt on their home, building a new property, or buying a new property. And, it really comes down to 3 things. They need to have viable income, viable credit, and the motivation to complete one of those transactions. And the best way to get a hold of us would be to visit our website, gogsf.com. And I will tell you that over the course of 2018, what we found is that we've done a tremendous amount of single close construction loans. So that's a loan that closes one time. It's for a new build of a home. And traditionally, that was a two-loan scenario. You went to your bank, you get what's called a bridge loan, you build your property, and then you have to do a construction to permanent loan. We have a product now that is for across all platforms that has a single close. And in this year, one of the reasons why we've been able to maintain revenue when others are kind of sinking back from really a soft year production-wise is because of the single close construction product. And we feel that we're an industry leader in that particular product set.
This is really a market-leading product then, right? I mean, no one else really has it, and it's something that just expedites the whole process of getting a loan. Is that the case here?
That's exactly right. Now, there are some others that have it. It's not as widely available as, let's say, a traditional 30-year fixed mortgage. And this is a 30-year fixed mortgage, but a traditional, FHA, VA, USDA conventional loan. We also have a variance from Fannie Mae that we were able to achieve that allows us to do a 95 LTV, so 95 loan to value. So you're only putting 5% down to build a home, and there's no requalification. So you don't have to requalify. Once you close one time, that's it. You have the loan, and you're not making any payments until you move in. To me, that's just a great product because, my mindset before I got into the mortgage business is to build a home, you had to have all of this money down, and it's this complicated thing. It's a dream of many to build their own home, but they believe that there's a financial burden that they just can't overcome in order to do it in the way of a down payment. And now, listen, we do USDA loans for construction. It's 100% LTV. They put absolutely no money down, and they make no payments until they move in. So for a first-time home buyer, someone who is carrying a housing payment and now they need to sell that home in order to move in, it's a great option because they're not making two housing payments during the build process.
Right. So again, it kind of goes with your overall company's philosophy of making things easy and as quick as possible for all parties, right? The originators, the borrowers.
Right.
Fantastic. Thanks for joining us today, Chad, and sharing how you accelerate your company's high-value sales.
Absolutely. Malcolm, I appreciate your time. Thank you.
We've been speaking with Chad Jampedro, the president of GSF Mortgage Corporation, about his company's rapid growth. For interviews with other fast-growing, high-value sales companies, or to learn how we can accelerate your firm's high-value sales through automation, visit eversprint.com.